the Meet Your Fund Manager segment, where we are speaking with Aniruddha Naha, who's a fund manager at IDFC Tax Advantage Fund. He now joins us to discuss the fund and the outlook. Aniruddha, good to have you on the show. What has been your strategy as part of this fund?
See, as a strategy, frankly, what we do across IDFC is we try and look for good companies across businesses. When we say good companies, what we intend to look for is companies which have gone through a business cycle, are either the leaders or consolidators in their businesses, or are able challengers in their sphere of business. Having objectively looked at companies in this framework, what we try and do is we try and figure out what kind of leverage the balance sheets carry, or what kind of debt is there. And we usually as a house do not like too much debt on any of the companies that we are looking at. So frankly, it's what we try and do is look for good companies which have gone through business cycles, and then finally we come down to the financials, where clearly we try and see earnings, we try and do our earnings projections, as well as the fact that it should have less or manageable amount of debt. Free cash flows, if these companies generate free cash flows, they are the best part of it. And as a strategy, we try, the fund tries and manages the fund has about 30 to 35 stocks, at the max 40 stocks. Concentrated portfolio with a good set of companies is what we try to do.
The one-year returns for the fund have been better than the benchmark, so that's been fairly encouraging. But of late, the fund has been lagging behind compared to the benchmark performance. Why is that?
Equity investments are a little long-term. So if you look at it on a 1-year, 3-year to a 5-year perspective, I think the fund has done pretty well vis-a-vis the benchmark. It has probably in the near term probably lagged the index, but we wouldn't be too bothered about it, frankly speaking, because we take a view with at least a year or so while investing into companies, and we ride the business cycles. As of now, probably a little bit of an underweight position in some of the beta sectors could have been a reason why you might have seen a near-term underperformance. But I think clearly we are pretty positive on the companies we hold, and with a little bit of a longer-term perspective, I think the fund should come back pretty well.
So what sectors are you overweight and underweight on respectively in this fund?
Clearly, one thing which is where we are running a differentiated strategy is we are running a decent underweight position on our financials. The reason why we are doing that is, one is we do not see the interest rates coming down in the near term anytime soon. That is one. Secondly, growth is going to be, if not, it's not going to come back very soon. It's probably going to be back-ended, and hence to that extent, earnings for the banking sector is going to take some time. And finally, we do not see the asset quality cycle to have bottomed out. Maybe you could see some amount of more pain going through the cycle. So that is one reason why we are running a decent underweight position on banking. On the other side, we are running an overweight position on IT and pharmaceuticals and consumer discretionary. So we are still playing the rupee game and running a little bit of a neutral kind of a position on the cyclicals.
I see a lot of focus on cyclicals, banks as well. What is your view, in the whole debate between cyclicals versus defensives at this point?
Just as I had mentioned, banks, though there might be a few number of banks, but as a percentage vis-a-vis the peer set, we are running an underweight position. We will continue to run that underweight position for some time. Unless and until we are sanguine that the asset quality issues have more or less got resolved. And also the other thing with the banking sector is capital is going to be a big constraint for growth, especially among the public sector banks. So we'll keep that at the back of the mind. Once we see these two issues getting resolved, we'll take a more positive view on the sector. On the cyclicals, we are pretty much neutral, and what we have done is we've stuck to good asset or businesses where leverage is very much manageable or completely non-existent, and we see decent growth in these specific companies. So cyclical as a strategy for the fund, we run it up as a bottom up, and specifically in this case, when we do a bottom up, we have tried to select companies where we think they are leaders and they have a decent balance sheet to carry them forward as and when growth comes through.
And finally, in IT, the exposure among top 10 holdings is, of course, in Infosys. What is your stock selection approach as far as the technology sector is concerned?
One thing as a strategy is among our top 10 stocks, we have Tech Mahindra, HCL Tech, as well as Infosys among our top holdings. We haven't gone down too much the market capitalization because we've seen that in good times the smaller companies do participate, but when probably if there is an adverse impact on currency or if things become tough, the smaller companies find it very difficult to manage the environment. That is why we've stuck to the better names, and among our top 3 or top 4 holdings in IT, we have Tech Mahindra as our largest position, after which there is HCL Tech and Infosys. Among the top 10 stocks in the fund, we have these 3 stocks present from the IT sector.